The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon. Thank you for joining us. My name is Sefi Silverstein, and together with my partner, Len Nitty, we are your presenters today. We're going to be providing you with an overview of the new tax act that are relevant to those in real estate. Before we begin, just a few housekeeping notes. If you have any questions, please use the questions pane in the GoToWebinar dashboard on your screen. We'll attempt to answer as many questions as possible, but we do have a lot to cover, and just in case we can, we certainly are available after the webinar. For those who are here for credit, in order to obtain the credit for either CPE or CLE, please answer all the polling questions, and also kindly complete the survey that will be emailed after the presentation. Once this webinar is done, it'll be recorded and uploaded to our website. And now this is our agenda for today. We have the depreciation provisions, qualified business income deduction, the business loss limitation, net operating loss deductions, deduction for business interest, and some miscellaneous provisions. So we have a lot to cover. So let's begin with the depreciation provisions. I'm going to very quickly summarize the current laws, what we have available, and what the new laws are, because I think you're going to find that this is going to provide a nice deduction for many of our clients this coming 2018 year. Just as a recap, we have several methods available to us. Most of the assets are written off over the modified accelerated cost recovery system. This system assigns the specific class asset and the specific useful lives. Additionally, we have two accelerated methods, the Section 179 method and the bonus depreciation, and there are changes to both of these too. And finally, we have an alternative depreciation system, which is a decelerated method, which we've not seen in the past, but may be seeing this a little bit more frequently going forward. These are the class assets and the class lives. And when we refer to the Section 179 and bonus rules, they typically apply to those that have a class life of less than 20 years. Those are the furniture, fixtures, and equipment, land improvements, and certain leasehold improvements. Often we recommend cost segregation studies because obviously the more of an acquisition price that can be allocated to the shorter lives, the higher the depreciation in the earlier years. Also, recently, Congress has carved out for us accelerated write-offs pertaining to leasehold improvements. And rather than the 39-year write-off period, leasehold improvements started to receive more favorable tax treatment. Initially, when these leasehold improvement rules first came out, they were somewhat limiting. For example, the building would have to be 3 years old in order to qualify. And some additional limitations, such as leases between related parties, didn't qualify, as well as some of the larger improvements. Then during the PATH Act in 2015, those limitations were slightly reduced, and they were more applicable to other improvement property, and they loosened up some of the rules. There was no 3-year waiting period, and etc. So as we stand now in 2017, we have a lot of methods and options available to us. But specifically with Section 179, it's a dollar limitation of immediate expensing of assets acquired. Again, these have to be for assets that are less than 20 years. Once you start to exceed purchases of over $2 million, then this immediate expensing starts to phase out. The important thing to note about 179 is that it was available for both new and used property. Additionally, 179 is typically not available to rental properties except for some of the leasehold improvements. Components of a control group need to take into consideration all the acquisitions of the control group in order to determine if they'd exceeded the phase-out limits. So what's new with Section 179? Immediate expensing is now at $1 million of qualifying property, and once you start acquiring property in one single year that exceeds 2.5 million, you start to see a phase out. Also, 179 now applies to expanded properties such as roofs and qualified energy efficient heating and air conditioning property, fire protection alarm system, and security system, non-residential. So this is applicable for property placed in service after 2017. Again, if you are under the aggregation rules, you need to take a look at this and all properties and consider them as one. Also, prior to 179, prior to the new act, this immediate expensing was not available to properties that furnished lodging, which was, for example, multi-housing and apartments. The Tax Cuts and Jobs Act has expanded this, and now the definition of 179 property applies to those used for predominantly to furnish lodging. For those of you who are familiar with the de minimis rule, we already are able to write off purchases where a per item cost is less than $2,500. So in the context of multi-housing and residential, we already have an existing write-off, but this might be applicable to some other assets in greater than $2,500. Bonus depreciations, where I think we're going to see a nice deduction here for many of those that are on real estate. Under current laws, and bonus, unlike Section 179, is not a dollar limit. It's typically percentage. Also applicable to property that have a class life of less than 20 years. Bonus does not have any limitation on phase out, and it doesn't matter how many properties you own. There are no aggregation rules. So this really is applicable to many more people in the real estate industry. The important thing to note with bonus that previously it applied to only new properties. So if you purchased an existing property that had an allocation to FF&E, that did not qualify for bonus because you were not the first user of that category of property. Bonus was scheduled to phase out and reduced to 40% in 18 and 30% in 19. You should note that most states in New Jersey, New York, PA area do not recognize bonus. This is just a federal deduction. Under the Tax Cuts and Jobs Act, now the expensing is up to 100% of the adjusted basis of the qualifying property. And a very important change to note is that it no longer needs to be new property. So if you bought an apartment building and allocated to that was $2 million of FF&E, you can now, in 2018, write off that $2 million of FF&E. One interesting thing to note, a lot of the provisions we're going to be discussing are applicable for tax years after December 31st, 2017. With bonus depreciation, it applies to assets acquired and placed in service after September 27th, 2017, which provides an opportunity in the fourth quarter of the past calendar year for many to consider this immediate expensing of assets acquired. Bonus also will not apply to an electing real property trade or business, which we'll discuss in a later provision. And it is scheduled to phase down for tax years starting in 2023 and scheduled to be completely repealed after 2026. And some additional changes from the Tax Act applies to the ADS recovery periods, which is that decelerated method I mentioned earlier, which you'll see might apply in another provision down the road. And so for now, we have our first polling question. Under the new law, the bonus depreciation write-off for qualifying assets is We're good? So let's see, what does the audience say? I'm not able to say.
The majority of the audience said the 100% qualifies for
Okay, terrific.
immediate
Okay.
expensing.
So now Leonard's going to discuss the qualified business income deduction.
Thank you, Sefi. And we're going to spend some time on the qualified business income deduction, which is going to be generally pretty favorable to the real estate industry. And I think overall this tax act has been pretty favorable to the real estate industry. And you'll see where there's certain provisions written into this tax law to be specifically friendly to the real estate industry and some of the associated professionals that works with it. So we'll get started here. And this is what's also known as the pass-through deduction. I think it's received more press as a pass-through deduction. It's important to note that it just doesn't apply to pass-throughs or partnerships and S-corps. It applies to any qualifying business, including sole proprietorships or perhaps Schedule E activities. And the one caveat is it's available only to non-corporate taxpayers. So it's going to be individuals, estates, and trusts. And I think we can start with the presumption that every business is going to be entitled to a 20% deduction of your qualified business income, except that when you start to make too much money, they start to claw back the deduction and place some limitations on it. So a lot of what we're going to go through in the next few minutes is going to be what are some of these limitations that are imposed on this 20% deduction, and at what income levels do they start taking it away from you. So we're going to talk about what is a qualified trade or business, and this is where we're going to get into our first limitation. And it's any trade or business other than a specified service trade or business. So they're automatically taking out a number of service providers from qualifying from this if you're deemed to make too much money. And we'll get into what those income limitations are in the next slide. So I am going to read this next bullet because I don't want to leave anybody out. Specified service trades or businesses include healthcare, law, accounting, actuarial science, consulting, performance arts, financial services, brokerage services, any trade or business where the principal asset is the reputation or skill of one or more of its employees, owners, or any trade or business which involves the performance of services that consists of investment and investment management. So essentially it's capturing most service providers based on some of the generic terms like consulting or any trade or business where the principal asset is a reputation or skill of one or more of the employees or owners. Two that are specifically excluded from this definition and still qualify for the deduction are two very friendly to the real estate industry, and those are architects and engineers. So keep that in mind. If you're an architect or engineer, you're not on the bad service provider list. If you're someone like us as accountants, we are on the bad service provider list and don't necessarily qualify for this. So one big question that comes up is, what about rental real estate? How is rental real estate going to qualify for this? And one thing that seems to be clear from reading the code on this, or the Internal Revenue Code, is that there's a trade or business requirement. All the references are to trade or business. And at what point does rental real estate activities rise to the level of a trade or business? We don't have a bright line test provided to us by the Internal Revenue Code or tax regulations. What we have is some case law that gives us some criteria. And you rise to the level of a trade or business if your activity carried on to make a profit, and you can conduct these activities on a regular basis. So I think if you have an apartment complex where you have a number of units and you're providing management services to the residents, and you're providing janitorial services, and perhaps you're providing maintenance services, there you're really running a trade or business. You really have a high level of transactions for purposes of this test. Where you may get into some trouble is if it's a triple net lease property and all you're really doing is collecting a rental check each month and writing a check for a mortgage payment and not doing much else. I think it's a little more difficult to make the argument that you qualify for a trade or business. And at some point between a fully operational apartment complex and a triple net lease, we're going to get to the trade or business answer. It's just not clear exactly where that would be, and it'll be based entirely on facts and circumstances. one thing which we may see in the regulations when they are issued, and hopefully we'll get something favorable for real estate professionals, the net investment income tax, we were all grappling with whether or not, rental real estate could rise to the level of trade or business. They gave us a very favorable ruling in the regulations, stating that if you're a real estate professional and your activities are considered to be non-passive, you're going to not be subject to the net investment income tax. And they took it a step further and said, if you aggregate all of your activities together as a real estate professional, none of your activities will be subject as long as you have real estate professional status and you meet the 5-hour test for all the rental activities that you've grouped together. It's possible we get a nice favorable test or safe harbor test like that in these regulations, but we'll have to wait and see. So I gave you the whole list of service providers that don't qualify to take this, and I had mentioned right at the start of this segment of the presentation that they only put these limitations on you if you're deemed to make too much money, and here's the definition of where you make too much money. For a taxpayer whose taxable income does not exceed $157,500 or $315,000 for a married filing joint filer, you don't have to apply this service provider exception. You still qualify for the 20% deduction subject to a taxable income limitation that we'll talk about later. And there's a phase-in of this exemption for taxpayers who make a little bit over the 157 or 315. For married filing joint, to the extent that you don't exceed the 315 by $100,000, you'll get a prorated amount of this 20%. And for those that are other types of filers, if you don't exceed it by $50,000, you're entitled to a certain percentage. And these will be indexed for inflation each year. So I see a quick question as to whether 1120 S corporations qualify. And this is the individual owners could qualify for this, absolutely. The pass-through entities are viewed at the bottom of the food chain when it gets down to the individual or trust or estate return. So certainly S corporation shareholders could qualify for this deduction. One important thing to note is we're going to go into another discussion in a minute, and you have to look at each different line of business separately. But we'll talk more about that in a minute. So what is qualified business income? Essentially, qualified business income is going to be any income from a qualifying trade or business with the exception of any investment income. So that knocks out capital gains, dividends, interest income. It also excludes publicly traded partnership income, but you're going to see publicly traded partnership income will actually get a favorable treatment, and that'll come back in later on when we go through these limitations. It also does not include reasonable compensation or guaranteed payments paid to owners. So we're to the next limitation now, and so our qualified business income amount is either going to be the 20% of the qualifying business income, or we're going to be subject to a W-2 or W-2 plus basis test. And the first leg of this test is 50% of the W-2 wages that the qualified trade or business pays. So in a lot of rental real estate or real estate businesses in general, you may not have a significant amount of wages being paid. So what was written into the law at the last minute, and this was not in the Senate or the House bills, this actually came to be as part of the reconciliation between the two bills. They wrote in that you get to take the greater of the 50% of the W-2 wages or the sum of 25% of the W-2 wages plus 2.5% of unadjusted basis of qualified property. Essentially what qualified property means is that you haven't fully depreciated that property. You haven't extended the useful life of that asset yet, with one exception. Anything that's 10 years or below, you get to consider for the first 10 years that you own that asset. So whether it has a 5, 7, or 10-year life, it's automatically considered to be qualified for 10 years. So I think that's where the real estate industry is really going to benefit here, and this was written in with the real estate industry in mind, that they didn't want to exclude apartment building owners and other real estate types of investments due to the lower wages. they really beefed up the limitation by giving 2.5% of the unadjusted basis of the property. And then you add in 20% of qualified REIT dividend income and publicly traded partnership income afterwards, after you apply the limitation to your regular qualified trader businesses. As I said, the deduction is calculated for each trader business separately. You don't get to aggregate these amounts as we stand today. Perhaps when we get tax regulations, if a real estate professional makes the election to aggregate all of their rental activities, perhaps we'd be able to aggregate all of our rental activities at that point, but I don't want to speculate. I'm just throwing it out there as a possibility. But as we stand today, you'd look at each one separately to determine whether or not you qualify for this potential deduction. So definitions, I think we gave the definition of qualified property and the depreciable period. Qualified REIT dividend is going to be any dividend from a real estate investment trust that doesn't receive preferential capital gains or qualified dividend tax treatment. Qualified publicly traded partnership income is going to not only include the annual income from that publicly traded partnership, but also any ordinary gain that you recognize on the sale of the publicly traded partnership. So figured take this through with a quick example, try to solidify what I was explaining. Taxpayer A as an individual owns an apartment complex which has $2 million of net business income, paid $200,000 of wages in the business, and has a $10 million unadjusted basis of qualified property. What is a taxpayer's qualified business income deduction? So we go through the two-part test. First part is just taking straight 20% of our qualifying income. That gets us to a maximum deduction of $400,000. And then we look to the greater of 50% of wages. So 50% of $200,000 gets us to $100,000, or 25% of wages, which is $50,000 in our example, plus 2.5% of $10 million, which is $250,000, for a total of $300,000. So when you compare the 100 to the 300, we're entitled to the greater. So our limitation is going to be $300,000, which is less than the actual 20% calculated amount. So you can see they're taking a $100,000 haircut on this deduction based on this limitation.
Len, just to put things in perspective, how the different provisions will affect each other, the bonus depreciation rules, in this example, if the net income was dropped to $1 million because we took an aggressive 100% bonus write-off, then obviously net income would go down, and so would the flow-through deduction.
Absolutely.
So
it's after considering all expenses of the
Right.
company. So if you're taking bonus
and accelerating your deductions, you're also dropping your income, which may impact this deduction.
Correct. It would impact this deduction, but
Right.
by taking bonus, you're getting a dollar for dollar benefit. Where
Right.
here you're only getting a 20% benefit. So in a lot of cases, you'd still be better off taking bonus, but it's worth considering how much of this 20% deduction you may be losing out on. So the exception to the ways and base limitation is the same exception for the service businesses, where if you don't make too much money, they're going to still allow you to take this deduction. They're not going to apply that wage or basis limitation to you. Same threshold amount, same phase in of the exception. So just keep that in mind. I don't want to spend too much time on it since it's a little repetitive. So if you still have any qualifying business deduction after getting through those first limitations, we're now to our third limitation. That's going to be that you have to have enough taxable income in order to be able to absorb this deduction. So the next limitation is you get to deduct the lesser of the combined qualified business income amount of all your different entities, or 20% of the excess taxable income over net capital gains. So if you have a taxpayer that has significant capital gains income, you're going to have to reduce your capital, you're going to have to reduce your taxable income and take 20% of that and compare it to your qualified business income amount or deduction that you calculated already, and whichever one is lower is what you get to deduct. And then you add to that the lesser of 20% of your qualifying cooperative dividends, or the same taxable income limitation that was imposed on the first leg of this test. We don't see too many qualified cooperative dividends in the real estate realm, but just keep that in mind. If you have any, you still could get 20% of those dividends as a deduction as well. So here's an example. Individual A has a qualified business income amount of $100,000 and taxable income of $800,000, which includes $400,000 of long-term capital gains. What is individual A's qualified business income deduction? So the deduction is a lesser of $100,000, which is the calculated deduction, or $800,000 less the $400,000 of long-term capital gains at 20% of your adjusted taxable income, coming to $80,000. So you can see again, this taxpayer would be subject to a limitation, and their deduction would be limited to the $80,000 based on taxable income. If you have tiered partnerships, the IRS is going to have to issue regulations to see how that's going to be handled for purpose of this deduction. It's not clear if you'd have to look at each partnership that a holding company owns separately as it gets passed down to the individual estate or trust owners, or if you get to look at that holding company on an aggregate basis. The regulation, the code didn't address how this is going to be handled. All it did was tell the IRS that they need to address regulations in this area. And if after looking at all your qualified business income and expenses for the year, if you end up at a net loss for the year, you won't be entitled to the 20% deduction this year. Plus, you have to carry that net loss forward to the following year to reduce any future 20% deduction that you may be entitled to. So keep that in mind as well. They don't want you to be able to generate a large loss in one year with bonus depreciation, and then be able to take advantage of the 20% deduction the following year. So with that, I'm going to turn it back over to Seffi after we get through a polling question. The new qualified business income deduction, A, applies to all businesses. B includes investment income. C provides a deduction of up to 20% of qualified business income. D is subject to simple calculations. So, and while we're waiting for the poll questions, I think when some of the legislators were talking about this tax act, maybe even the president at times, there were some whispers that this was going to lead to a simplified tax code. And I think after you get through today's presentation, you're going to be scratching your head a bit and want to know what happened with all of the simplification they were talking about, because in our opinion, the Tax Code Act has actually gotten much more complicated with all these new deductions and limitations. So the answer to this one is C. It provides a deduction of up to 20% of qualified business income.
Are there any questions that you feel we could answer at this time? Or
let's see where we are with time at the end.
Okay, if you have time at the end, we'll continue with some questions. So I'm going to discuss the next two provisions because they sort of go hand in hand, and that's the business loss limitation and the net operating loss deduction. So under the Tax Cuts and Jobs Act, this is applicable to all non-corporate taxpayers engaged in any business. The net business losses are going to be limited to $500,000 for joint filers or $250,000 for other taxpayers. And for the pass-through entities, this is applicable at the partner or shareholder level. Any excess business losses due to this limitation will be carried forward as a net operating loss. Okay? In addition, there are changes to the net operating loss deductions. Prior to the Act, net operating losses could be carried back 2 years and carried forward 20 years. The deduction was not subject to any limitations based on taxable income. So for example, if you had taxable income in the current year of $1 million, and you had an NOL carry forward from a prior year of $1.5 million, it would eliminate your taxable income in the current year, and you would have $500,000 carried forward to the next year. Up until 2017, including this year, we can still elect to either carry back or carry forward. And sometimes the decision to do that often depends on facts and circumstances. For example, if in 2017 there is a net operating loss of $2 million, you'd have to carry it back for the most recent 2 years, and that would be 2015. What if 2015 the taxpayer had a significant taxable gain, a long-term capital gain? So the carryback will recover taxes paid at a 20% capital gain rate. Instead, what if the future projections are ordinary income? Would we then forego the carryback and instead carry it forward and recover taxes at a higher rate? So these are always discussions to be had based on facts and circumstances. Starting in 2018, the carryback is repealed, so there's no longer an option to carry back any losses, but the carry forward period is indefinite. The NOL, the deduction is also going to be limited to 80% of taxable income. So NOLs that arose prior to tax year 2018 are grandfathered. They can still be carried back, and they can still apply to taxable income without limitations. So for those taxpayers that do have NOLs generated in 2017 and prior, we're going to have to track those separately because they are not subject to the limitations for NOLs arising in 2018 and later. And we have an example here because this helps illustrate the impact. And what we have, consider a taxpayer in 2018, and think of this as page 1 of the personal income tax return. This particular couple has no wages. They have interest and dividends of $150,000 and capital gains of $250,000. So they have other sourced income of $400,000, and they're real estate professionals, and they have rental properties that generated $2.9 million of losses, and then they had some rental properties that rental income that generated $700,000. Their net rental losses are $2.2 million. Starting in 2018, only $500,000 of those losses can apply to the other income categories. And in this case, this couple still doesn't have taxable income because their other income is less than $500,000. So what is the impact for this couple going forward? They're going to have an NOL carryover to tax year 2019, and it's going to be comprised of 2 items. Number 1, it's going to be the excess business losses that we couldn't deduct in the current year of $1.7 million, plus the $100,000 loss that the taxpayer still shows even after use of $500,000. So we now have a $1,800,000 carryover into 2019. Let's forward this couple to the following year. And now in 2019, they have a slight change of income categories. They now have wages of $750,000, interest and dividends of $150,000, and significant capital gains for about $1.9 million. Again, the net rental activity, their business losses were $1.5 million, and they can only apply $500,000 in the current year. So prior to any net operating loss deductions from prior years, we're at $1.4 million. But the new rules require us to look at 80% of $1.4 million. And in this example, we can apply $1,120,000 of the carryover from the prior year. And in this example, there is taxable income of $280,000, despite the fact that there are significant losses incurred. And if we now look at what their net operating loss is to the tax year 2020, again, it's the sum of the current year's business losses that they couldn't use, as well as the remaining carryover losses from a prior year. So $1 million plus the $680,000 results into a new NOL carryover of $1,680,000. Now what we're going to do is just take this one more year and assume they have no losses. They have rental positive income for a total of $2.4 million in 2020. They're going to be able to apply the entire NOL from the prior year because that is less than 80% of the limitation of $1,920,000. And at this point, they have absorbed all their losses and have been able to move forward with no more losses. If 2019 was the first year, this is where they're going to have to wait. You know, if they didn't have an NOL carryover, then it would have, you know, it'd be a little bit more of a significant impact. They would have taxable income of $1,000,004 if this is their first year. Okay, so that takes care of NOLs and business losses. So now we're going to discuss the deduction for net business interest. So the Tax Cuts and Jobs Act applies to all taxpayers, both corporate and non-corporate. Under this limitation, the deduction allowed for business interest for the tax year cannot exceed the sum of 30% of the taxpayer's adjusted taxable income, but not less than zero, plus the actual business interest income. Adjusted taxable income is before interest, depreciation, and amortization, so it's pretty much similar to NOI. Any amounts that are unused can be carried forward indefinitely. I don't have the example up here, but just a very simple example. If you have adjusted taxable income of $100,000, 30% of that limitation would be $30,000, and if your business interest expense was $40,000, there would be a $10,000 excess business interest expense that would be carried forward. There are exceptions to the limitations on business interest deduction, and that includes a small business exception or an electing real property, trades, or businesses. The small business exception applies to a taxpayer that meets the 25 million gross receipts test, and that test is that if the taxpayer's average annual gross receipts for the 3 tax year periods prior to this year do not exceed 25 million. And if the aggregation rules apply, then all persons treated as a single employer, you have to combine all common ownership and look at it as one if the aggregation rules apply. If you are if the aggregations rules do apply, then your other exception could be the electing real property, trade, or businesses. An electing real property, trade, or business isn't a trade or business for this purpose if it's in any business which is real property development, redevelopment, construction, reconstruction, acquisition, conversion, rental operation, management, leasing, or brokerage trades or businesses, similar to those businesses that are under the real estate professional rules. So if these electing real property, trade, or businesses make the election, they are not subject to the limitation. And just note that once the election is made, it is irrevocable. If you make the election not to be subjected to the limitation on interest, then the offset is that you're precluded from using bonus depreciation, presumably on realty, and you must use what we discussed earlier in the webinar, the alternative depreciation system, which is a longer life write-off, and these are the categories of depreciation. So if you don't want to consider the interest limitation, you must consider limitations on depreciation or vice versa. It's one or the other. So in deciding whether to make an irrevocable election, A taxpayer with a real property, trade, or business must compare to the extent to which the limitations will affect interest deduction, or the extent to which the taxpayer will have to claim depreciation deductions at a decelerated rate over a longer period. What we don't have clarity on is this might be easy to apply to purchases of properties in 2018 and forward, but how does this apply to properties that are currently in place and several years into their depreciable lives? If we wanted to make this election, and do we now have a change in accounting method because we're changing the depreciation methods? We still have to wait for final regulations for more clarity on how to proceed with existing properties. So in terms of the deduction limitation, it's actually a two-prong limitation. Limitation is first determined at the partnership level. So in my example, before, if we determined that the limitation was $30,000 of business interest, but the actual business interest expense was $40,000, we have a $10,000 limitation. Think of a K-1 reporting of that $10,000 that's going to be included as additional information to each particular partner as they then trickle it down to their level, because then the limitation is determined again at the partner level. So it's going to be interesting to see how the reporting and everything needs to be reported during 2018 and after on the K-1s. Okay. So the next polling question is: an electing real property, trade, or business makes an election to avoid interest limitations, cannot use bonus depreciation on realty, must use the ADS recovery periods for real property, and all of the above. Okay. So where are we at?
So the majority said all of the above.
Excellent. Okay. All right. So.
All right. So another one that got quite a bit of publicity and was quite highly debated throughout the presidential election is carried interest, and how are you going to deal with the promoter of an investment vehicle that is potentially getting capital gains, long-term capital gains treatment on what otherwise might be considered to be their commission for putting together the deal. And carried interests were addressed in this tax law change, and they kind of took an in-between approach to it. They didn't quite go as far as many of us expected, where we thought that they would recategorize the income that's to a promoter of one of these types of investment vehicles to be considered to be ordinary income and, you know, trade or business income for them. They decided to take a halfway approach and flip long-term cap gains to being short-term cap gains, assuming that certain qualifications are met. And to take a step back, so when you have a carried interest, you have a partnership that's set up, and the promoter of the partnership gets a profits-only interest, meaning they only participate in income of this partnership if the partnership makes money and the underlying investments make money. They would be entitled to a percentage of the profits. And this only applies to partnerships that hold specific assets. I think everyone would expect that it would apply to, you know, stocks and bonds and other types of investment vehicles that are held by the partnership, but they extended it also to real estate. So if you have a real estate entity that owns real estate, it's considered to be a qualifying investment or a specified asset. And if you have profits interests that have been granted as part of that real estate partnership, the carried interest rules are going to apply to those profits interest holders. And I said that it, you know, reclassifies long-term capital gains to short-term capital gains. And the normal rules for long-term capital gains is once you've held an asset for more than a year and you sell it, it's considered to be a long-term capital gain if it qualifies for capital gains. And that's subject to preferential tax rates at a maximum of 23.8% when you factor in the 3.8% net investment income tax on top of the maximum 20% income tax rate. What they've done to try to discourage carried interest types of deals is not discourage them necessarily, but penalize the promoter of a carried interest, is rather than give long-term property treatment for those owners at 1 year, and more than 1 year, it's changed to be 3 years. So for only those profits interest holders, you have to look at whether or not they get long-term cap gains treatment based on a 3-year holding period of the underlying assets as opposed to a 1-year holding period for the other investors in the deal. What about Section 1031 exchanges? How was this impacted by the tax law? Good news to the real estate industry. 1031 exchanges still apply to real estate transactions. Business as usual here. This was really very favorable to the real estate industry. Where they did take something away from us is that 1031 exchanges no longer apply to the sales of tangible personal property. So how might this impact the real estate industry? Take a hotel, for example. When you sell a hotel, not only are you selling the real estate, but you're also selling, furniture and fixtures. And those furniture and fixtures no longer qualify for tax-deferred treatment when you roll it into the next property. So I think it'll become important when you're looking at purchase price allocations, even perhaps more aggressively than you've done in the past, to try to allocate value away from the tangible personal property, the furniture and fixtures, as compared to the real estate. So keep that in mind. Still very favorable to the real estate industry. You just can't defer the gain on any sales of tangible personal property. Rehabilitation and historic tax credits. This one there was a lot of uncertainty as to what was going to happen here based on whether we were going with the House Act or the Senate version of the bill. And the compromise they came to is that the 10% credit going forward has been repealed for certified rehabilitation buildings that were placed in service before 1936. That 10% credit no longer applies. What is still available is the 20% credit for historic structures. That remains in place for any buildings that are certified for the National Park Service. The one thing they did change to the historic tax credit, where historically you would get the full credit when it was placed in service, you now have to spread that credit over a 5-year period. So you get 20% each year for 5 years. So you have to wait a little longer to get that credit, but you still get the full 20% historic tax credit. So this is effective for amounts paid or incurred after December 31st, 2017. And there is a transition rule for buildings that are owned by the taxpayer on January 1st, 2018. So you've had this building before 2018. You can still take the 10% credit as long as you make the improvements or the qualified rehab expenses within the transition period, which is 18 months. So you have 18 months to start the work, and I think you have 2 years to complete it. So keep that in mind. Even though the law changed, if you have a pre-1936 building that you want that 10% credit on, you can still get it. You just have to move a little more quickly than perhaps you otherwise would have. So meals and entertainment. This is another one where it has gotten a little bit of publicity, and they've started to, as part of giving us more favorable tax rates, they've looked to take away some potential deductions for us. One was the interest expense limitation, which we talked about earlier. Another one was meals and entertainment. So a few things they did to meals and entertainment is going to be for employer-provided meals. So where you had an in-house company-operated eating facility. I always think of Google and the wonderful, cafeterias they have that are free of cost to the employees. Where you operate these type of eating facilities, those expenses that they incur for the food and beverages to run those facilities are now going to be subject to a 50% limitation. You can only deduct half of them. Once we get to 2026, these food and beverage expenses are going to be completely disallowed. It's also going to apply for meals furnished to employees on the employer's premises for the convenience of the employer, where Previously, a lot of these were available to be excluded by the employees as a de minimis fringe benefit and fully deductible by the employers. These are now going to be subject to the 50% limitation for other types of meals as well. Those types of meals that have always been subject to the meals and limitation are if you take a client out to lunch to discuss business with the client, or discuss business with another colleague that you network with, or you take employees out to lunch to talk business. Those are always subject to the 50% limitation. Now they've expanded that 50% limitation to these two categories, but specifically for these two categories, it becomes completely non-deductible in 2026. So keep that in mind. The other thing they did is for entertainment expenses that were previously subject to the 50% limitations, these are now completely non-deductible as well. These types of expenses include any activities considered to be entertainment, amusement, or recreation. Think about taking someone to a ball game, or taking someone to a show, or giving a client or vendor take us to a show, or you're taking someone out to play golf or something along those lines. Those are going to now be completely non-deductible expenses. Also, membership dues for any club organized for business, pleasure, recreational, or social purposes. These types of membership dues are also going to be non-deductible. Keep in mind, this is for clubs. This isn't deemed to impact dues paid to trade organizations like NJAA or NAIOP or chambers of commerce or things like that. It's only for clubs organized for these purposes. I guess maybe if you're involved with a networking club, those are an example of an expense that would be disallowed. And in addition to those two, any cost for a facility used in connection with either of these two categories would be disallowed as well.
Len, this creates a little bit more of an administrative burden, because if you take the example of taking a client to a show and dinner, the show is 100% non-deductible, but the meal might be deductible if you're discussing business during the meal.
Yep, absolutely.
So
we'll get into a quick recommendation in a second as to how they might be able to set up their chart of accounts to try to capture some of these expenses. Because I did want to talk about entertainment expenses that are not subject to this non-deductible rule. And these are going to be expenses for recreational, social, or similar activities, primarily for the benefit of the employees. So this is going to be your holiday parties, summer outings, perhaps some team building activities. You're still going to be able to completely deduct 100% of those. And important to note that meals for these types of activities are also 100% deductible. Additionally, the costs of business meetings for employees, stockholders, or agents or directors are going to be 100% deductible, so even if it's at an entertainment type of facility. But unlike the expenses for recreational, social, or similar activities for the benefit of the employees, the meals here are going to be subject to the 50% limitation. And expenses directly related to the attendance of business meetings or conventions are going to be 100% deductible as well. So going to the NJAA convention or similar types of conventions will still be deductible, as well as attending meetings to those types of organizations. So Stephanie alluded to this becoming a more complicated scenario for bookkeeping purposes, or I guess administrative purposes in general. So what we're recommending to a lot of our clients, where they've historically had just a general meals and entertainment expense category, is now you really want to start breaking it into 3 different categories. You're going to want one for all of your 50% meals and entertainment deductions. You're going to want to have one for non-deductible entertainment types of expenses, and one for fully deductible entertainment expenses, which are explained on this slide. So with that said, we're done with the presentation, and we'll turn our attention to questions for a few minutes. I think we have 4 or 5 minutes for questions, and anything that we don't get to or haven't already answered during the presentation, we'll address after the fact. So a number of you have asked if you're going to get a PDF of the presentation. Just note that that will be available up on our website afterwards. So question, would going to a Mets game be a charity and the Yankees non-deductible? I guess that's more of a joke, and I should have read it a little quicker, but unfortunately the Mets are still deemed to be for entertainment, even if it is not enjoyable entertainment. a few that had come in on the qualified business income deduction. So would the unadjusted basis be the cost or the net book value for applying that second limitation we were talking about, the wage limitation? It is the unadjusted basis as long as you're still within the depreciable life for that asset. Next one, most rental real estate activities have zero wages, so would the 20% deduction not be available? The 20% deduction would still be available based on the 2.5% of qualifying basis. So again, that was a very favorable one that was put in just for the real estate market, knowing that a lot of rental activities don't pay wages. And actually what's interesting that I don't think I mentioned when we went through the slides is there's an open question as to what happens when you have leased employee types of arrangements where perhaps you're working with a PEO and you've transferred payroll over to that PEO for the benefits that they can offer you and just to administer the payroll. It's unclear whether or not you'd be able to utilize the wages paid through that PEO because it says it has to be W-2 wages of the employer or the business trying to get this 20% deduction. We're hopeful that the regulations address this and do allow for businesses that have shifted their payroll over to a PEO to still qualify for this deduction. You know, where I would correlate it to is recently there was a favorable ruling for research and development expenditures where you can get a tax credit rather than against payroll taxes. It is applicable where you have a PEO type of arrangement in place. So perhaps when we get final regulations, we'll have something similar for this test.
Len, I know we don't know when that will be, but the final regulations we're hoping will be out by the summer.
Yeah, we're a long ways off from final regulations, but hopefully we have proposed regulations by the summer so that we have some sense of how the IRS is interpreting these laws. And it would also give some level of time to allow them for, you know, to take some comments on those regulations and adjust them as they see fit before we actually get into the 2018 filing season next year. But the final regulations may be a whiles off. We at least need proposed regulations prior to the 2018 filing season. Another question, what happens to NOLs established in prior years? Will they be limited under the new rules?
No, they will not be. Those are not subject to the new rules, so there's no limitation on the taxable income of 80% like there is for losses that are incurring in 2018 and thereafter. So we will be tracking those NOLs separately and not applying the limitation on those NOLs.
And I think as you were going through the 500,000 or 250,000 net loss limitation, there was a question that if the limitation would not only apply to rental activities, but also real estate activities like home building development and the like. And yes, it would apply to any trader business. We just happen to use rental activities in the example.
Correct.
So with that said and answering that final question, I think we're out of time. So thank you for both of us for attending today. Hopefully it was useful. If you have any questions that come up after the fact, please feel free to email us.
We know there's a lot of material that we covered in a very short period of time, but we wanted to limit it to just a 1 hour lunch situations to make it easier for your schedules, but certainly give us a call if you need any further clarifications or if you have any further questions.
Yeah, and hopefully the IRS cooperates and we get regulations sooner rather than later to clarify some of the unknowns that came out of this tax act. Yes. So keep an eye out for that. We will be issuing tax alerts as we get those clarifications and making sure that everybody is in the loop.
Thank you.